Hi guys, it's Maynard and Mike. It's Close of Business Tuesday. Welcome to today's show. We think we've got something really exciting for you. We have the usual cast of characters. Besides Mike and myself, we've got Matt Portillo and Colin Fenton. But we're joined today by Ben Ratner from the Environmental Defense Fund. And so I think it's going to be a really exciting conversation. Ben's been doing this for a long time. And I know from the pregame, it's going to be some really good topics. Craig Webster is also joining us. He leads TPH's ESG effort, and so he'll be getting in on the action. But before we get to today's main attractions, Mike, oil, you said the over-under was $40 by the end of the year. It must be the end of the year.
Yeah, we're there.
We're over 40.
Yep.
What's happening?
Look, I think it's what's happening is demand's been better than people had expected at this point in time. You remember we were talking about demand being down 25 million barrels or so at the trough, and now I think most people are estimating demand's only down around 10 million barrels, so around 90 million barrels a day of demand, and that's much higher than people have thought we would be at this point in time.
What demand stats are people looking at to come to that comfort level, or what's driving the sentiment?
I mean, everyone comes up with the way they look at things, but a lot of it, it's either upstream or downstream generated. So that's where the numbers are coming out.
But it's not airline numbers or miles driven.
No, I think a lot of it just global demand. The Chinese economy, Indian economy coming out, and different economies coming out. Demand is just improving.
And are you seeing Wall Street price forecasts starting to go up too? I think we said about a month ago, we said the average forecast for next year was $46. Yeah. That was average WTI. Is it ticking up?
Modestly, but I think people still are in disbelief. We're not. And, one of the things we've been talking about for the last 2 or 3 weeks is that we thought, crude oil will consolidate around high 30s before the next move higher. We still think that's going to be the case. And the reason we think that's going to be the case is because, once we get past sort of mid-July, maybe third week in July, you're going to start to see U.S. draw pretty handily, and you're going to see global draws that are going to be pretty handily. And so I think what you're seeing is you're going to have a market that's going to be probably 4 to 5 million barrels in deficit. And so prices are probably going up. I mean, that doesn't mean we're going to go to $50 or $60, but I just think trying to fight a demand improvement as well as a supply decline is going to be very tough for commodity traders. I see a lot of commodity traders right now are sitting on the sidelines. They see the next couple of weeks as a little bit, volatile, probably going sideways. But I think most are lining up to have a more aggressive July, August type trading orientation.
So do you have a revised over-under for the end of the year?
No, I still think, 45 to 50 makes sense here.
Well, that's up, Mike.
That's up. But, but look, I think demand has come back a lot faster than we thought. But guess what? People are concerned right now with Texas, Arizona, Florida, whether we have a second wave of coronavirus and shutdowns occurring as well as globally. And so I think if you don't see that occur over the next 3, 4, 5 weeks, and we can get over this, then demand's probably going to continue to go higher. Supply is going to stay intact, and you're going to have a market that's going to be massively undersupplied, and prices are probably going up.
So, Matt, let me jump to you next, because Mike mentioned end of July, we might have some draws. That might be the next solid move in the oil market, potentially. That's also when earnings start. What are you thinking ahead about earnings, or what's on your mind this week?
Yeah, Maynard. It's been a pretty constructive dialogue, I think, starting on the upstream side of the equation. One of the key things that we've heard from management teams is that as we head into 2021, companies are really shifting their focus away from growth, which had been a big problem for investors over the last few years, and really focusing on a number of different metrics that clients have really been pushing management teams to focus on from a capital allocation perspective. So one of the key things I think you're going to hear from a lot of the upstream companies as we head into earnings is that they're really going to set a maintenance capital program for 2021 as the base case. And that's constructive for the macro backdrop, because I think the biggest concern is that with so much supply offline from OPEC, that the U.S. would start ramping up production, and that would cause some consternation. And so I think the one good thing we've heard here so far is unless crude has a 5 handle on it, most companies are going to use 2021 as really a balance sheet repair conversation. I think that second point is really important because investors have been pretty clear that to want to put capital to work in the upstream space today, they need to see absolute leverage reduced. And companies are really focusing on debt pay down in 2021. Any upside above maintenance cash flow is really going to go to debt retirement. And I think that's a pretty constructive backdrop. And then I think the third thing that's really coming through on the forefront is the lack of desire to continue this double-digit growth rate that the industry's had over the last few years. A lot more focus on moderation of growth, getting down base declines, looking at a single-digit growth rate over the medium term, and really focusing on accelerating shareholder returns via dividend increases, debt pay down, and using free cash flow potentially for buybacks.
So, Matt, I think maintenance capital is like the expression, the energy transition. I need you to define it because a lot of people use it in different ways. What is maintenance capital? What does that mean?
I think in its truest form, when you talk to upstream investors, they're looking at what the capital intensity is needed to hold production flat on an exit-to-exit basis. So Q4 2020 to Q4 21, what kind of capital would you need to deploy to hold your oil production flat, which is really where you generate all the margins?
And most of the companies you cover, which is a lot, will they exit the year? How will their exit rate compare to their entry rate for 20?
It varies quite a bit. So we have some companies that have essentially shut down all drilling and completion activity, and that's where that base decline really becomes an issue. We're seeing, in some cases, some of our larger cap companies down 20 to 25% exit to exit on volumes. But the benefit of that is actually their corporate base declines are coming down. And that's one thing that the industry's really fought over the last couple of years. This push for growth has accelerated base decline rates, and that's made the business models pretty tough to make structural investments in over time. And so as those base decline rates moderate, management teams are focusing more and more on cost reduction, whether it's controllable costs like LOE and some of the other initiatives that they've pushed through on the D&C side of things. And so I think that's going to set up for a more constructive backdrop for upstream as we head into 2021 and 2022. The knock-on effect to that, and what we've seen in the midstream space, I was talking with our midstream team today, there's a higher degree of confidence that the volume outlook for midstream is setting up for a fairly constructive backdrop in 2021 with relatively flat volumes. I think that the flip side of the conversation for midstream investors today is how do midstream companies allocate capital? And in the past few years, growth has also been a function of midstream capital investment. And today, with where the mindset is on kind of a structurally lower growth profile for upstream, clients are really looking for management teams to reduce their capital programs and really focusing on reducing absolute leverage. The leverage profiles in the midstream sector are still a bit concerning at these ratios. And so I think what midstream clients would like to hear from management teams is a reduction in CapEx and a reduction in leverage as we move out over the next few years instead of trying to grow into those metrics. The last thing I just add going into earnings, we should start to hear a tick up in service. We've already heard from a number of E&Ps that they're planning on bringing back frac equipment in July and August. That's going to help stabilize some of the base declines and actually work through their DUCs. As we go into September and October, you should start to see rigs feathered into the market as well as additional frac spreads. So the good thing is the bottom's in on service. The issue that we're facing in the service market today is just a drastic amount of oversupply of capacity. And with the upstream space setting a maintenance capital program in 2021 as kind of the base case, once you level set at Q4 activity levels, you're likely not going to see a big increase in activity. So there's still a lot to work through on the service sector, especially that excess capacity. And investors we've been talking to in the service industry would like to see attrition and consolidation as kind of the key focal points, as well as incremental balance sheet repair.
Okay, great. Colin Fenton, what's on your mind this week? I ask, even though I know, and I'm excited for you to tell the audience. Go ahead, Colin.
Thanks, Maynard. Picking up on a point that Matt just made, we don't have $50 oil prices in either the TI market or the Brent market in 21, but we do have the calendar year swaps above 50 now on the ICE Brent exchange for the year 2025. In fact, today the close was at 50.27, and looking forward in the NYMEX WTI market, that was a calendar year swap for 25 at 45.28. So it's out there. We're starting to see these prices emerge in those forward curves. And it's caught our attention that when we look at the CO2 emissions allowance futures market, and yes, there is one, which is also traded on ICE, that we're seeing a lot of motion in those prices too, as investors and corporates begin to anticipate the resumption of supply and demand in the forward period. And just to put some numbers on it, in just the past week, the active June contract on that exchange is up 12% in price to 25.35 euros per metric ton. That's the equivalent of about $28.69. It's still down year over year. We've seen higher prices in the past, but just to give a flavor to our hedge fund friends of what's happening in this market, the 25 euro strike calls on December 20 are up 78% in the past week, and the premium on that same strike has increased 130% in the past month. Looking at the 40 euro strike, which is a number that people commonly use when they do CapEx threshold calculations, in the past week, that premium's up 156%, and over the past month, it's up 310. So big moves. Now, having said all that, this is a market where the daily volume is still only 38 million metric tons. And to put that in context, that's about the equivalent of the entire annual CO2 emissions of Ireland. The open interest over the next 5 years is 916 million metric tons. That is the equivalent of the combined CO2 emissions of South Korea plus Spain for just 1 year, not over the 5-year interval. So the punchline is we're still talking about gigatons of emissions that are measured in 35 to 40 gigatons per year. And here's a market that has less than 1 gigaton looking out over the next 5 years. And a final point on this, it really strikes me that we often see a lot of people make the argument that there should be a carbon tax, and in fact that this is perhaps laying the groundwork for a carbon tax. And I think one caution of that is, and we've seen Microsoft make this point too, that you got to be careful that if you make the price go too far too fast, you'll begin to lose buy-in from both the supply side and the demand side that you might want to be there. And I know Ben and EDF spent a lot of time trying to bring people together, so I'd be curious to hear his view on this too. But one of the great lessons of commodity markets is don't go for the high price, go for the low price and breadth. So max, not tax. And that gets you to a spot where perhaps you can begin to get the aims that you want and to reclaim some of the carbon that's already in the atmosphere and create a dynamic market as opposed to one that's trying to stick a finger in the dike.
So Colin, for the uninitiated, which would include me, who's participating in these markets? What types of entities? Are there financial players in them? They don't sound really deep, so do they get manipulated? Who's in these markets?
Well, it all started about 15 years ago with the European Union creating, what was intended to be a form of a cap and trade market. And so it originated with self-produced numbers from the sovereign states of the European Union. Now, I happened to work at a hedge fund back in 2004, 2005 that participated in this market. And one of the challenges and obstacles at that time is one of the sovereign states decided that its numbers weren't right and added a lot of supply, and the price crashed. And we've seen that be a little bit of a challenge here, that we're trying to deal with a global problem from a regional policy perspective, which has obvious disadvantages. As the market has evolved over the past 15 years, the buy-in has expanded. And so I would say you have a number of global macro hedge funds who are on the bid side, and you have a number of energy companies, both producers and users, who are on the selling side. And that's what creates the market. It's both corporates and investors. And admittedly, if this open interest, we would like it to be larger, but it's starting to look healthier than it was. And we would want that breadth to carry along as many people as possible. And so when we do the straight line projection of the forward curve out to the end of the century, and there are problems with doing that, but just for the sake of argument, we still only get about a $65 per metric ton price in December 2100. And yet we're seeing some folks start to use numbers more like 70, 80, or 100. And so implicit in that entire architecture is a price view that may be right, may be wrong, but is not consistent with what we're seeing happening in the actual exchange of funds between investors and corporates.
Fantastic. Okay, well, Ben Radner, again, welcome. It's fantastic to have you. A little bit more about Ben. He before joining the Environmental Defense Fund, he worked at McKinsey. He worked at Latham & Watkins. He's a graduate of Stanford Law, as well as being a Rice Owl. So we Houstonians are particularly glad to have Ben. But Ben, I think your background illustrates one of the main points about the Environmental Defense Fund, which I'll let you explain it. You can do it much better than me. But, you guys are economics-based, quantitative-based, highly analytical and really searching for solutions that are, I think the word you used with me before was pragmatic. So now that I've stolen your thunder a little bit, could you introduce yourself and EDF to all of our viewers?
Absolutely, Maynard. Such a privilege to be on with you and your team. I've been looking forward to this for quite a while. I joined EDF about 8 years ago, and what attracted me to Environmental Defense Fund is that we roll up our sleeves and we work with businesses and investors on solutions to environmental problems. That's really the approach of our organization. It says on my business card and the business cards of all 700 of us now around the world, finding the ways that work. And to us, that embodies a kind of ambitious pragmatism where we're ambitious environmental advocates. One thing that means is heading for net zero emissions by 2050, but we're also pragmatic in how we work. We want to work on both sides of the aisle with Republicans and with Democrats. We want to extend our hand, open dialogues, and work with companies, including in the oil and gas industry, on the technologies, on the management practices, on the collaborative engagements, and on the public policies to really accelerate the energy transition and achieve a world that is cleaner, but also more prosperous. And we appreciate that business has a critical role, I might even say a leading role, in helping us get there in ways that are cost efficient.
There's one thing, well, there's so many things, Ben. And you said you're thrilled to be here. Man, we are crazy thrilled to have you. So technology and energy flavors. I think you're, sometimes the world gets hung up on what flavor it is it, and instead of focusing on, well, how reliable is it? How much energy do I get from it? How much money do I make? Is it affordable and profitable? And what kind of footprint does it have? And I'm leading the witness a little bit here, but I think you guys are flavor or technology agnostic, which I think we all find refreshing.
Yeah, I've heard it said that the energy system is the most complicated invention that humankind has ever come up with. And so it stands to reason that there's not going to be one single silver bullet solution that will solve climate change or that will achieve the energy transition. So at EDF, we try to take, like you said, Maynard, a technology neutral view. What we really care about is reducing emissions. And we know that there are any number of technologies and business models, many of them exist, some yet to exist, and will come to us through innovation that can have a key role in solving the problem overall. So I think it's going to be more of an all of the above type of strategy, as opposed to it's just renewables, or it's just energy efficiency, or it's just carbon capture, or it's just natural gas.
And would you mind sharing with us, in your time there at EDF, what it's been like to go call on energy companies, talk to management teams, go to boardrooms, how it's changed, where you've been made more progress than in other places, not specific names necessarily, but as you look at your history, what's worked, what hasn't worked, what are some ups, what are some downs? Talk to us.
I got to say, it's evolved a lot in the 8 years that I've been at EDF. In the early months and years, it was a lot of knocking on doors. It was some cold calls and introducing ourselves as the organization. What's happened now is that's flipped. And we actually receive a lot of calls. In some cases, we receive more calls than we can even handle. And I think the biggest reason for that is that ESG has rocketed up the radar screen of investors and therefore of management teams. And I think more and more executives are starting to really understand that having a good story to tell on ESG, and for this industry that especially, of course, means climate, energy transition, decarbonization, that has become business critical. It's not a nice to have. It's not secondary. It's something that the market increasingly wants and even needs, with the idea that access to capital may be on the line today, or if it's not, it increasingly will be tomorrow. I've really enjoyed my time in EDF and working with folks in the energy industry. You know, we work with a number of super majors, with some independent E&P players, of course, with some electric utilities and pipeline players. So we try to cover the value chain or come as close to that as we can. And we feel like we've made some real traction on methane emissions. Methane is about 85 times more powerful of a climate change forcer than CO2 over the next 20 years. And so the environmental case for solving methane is incredibly strong, and the business case has become strong. It's wasted natural gas. Wouldn't it be better to monetize that and keep it in the pipe in the system? And methane also undermines the case for gas, which we know is increasingly a part of the strategic planning and the CapEx for a number of firms in this sector. And so as they're fielding questions from a skeptical society in some cases, and from the media and from investors and from groups like ours, we're seeing this recognition at the C-suite level that virtually eliminating methane emissions is an important thing for these companies and for the future of natural gas in a transitioning economy.
Well, Ben, can I ask a follow-on there? Then you mentioned investors, and a lot of the work you've done lately has been around flaring. And what's the dialogue with investors when it comes to things like not just flaring, but methane emissions overall? Have you seen it evolve over the last year or so, where it's actually being viewed as an investment risk?
It's evolved tremendously. I remember in the early days, we would go knocking on the door of, let's say, a private equity firm or a university endowment or a public pension fund or even a large financial asset manager. And they would say, you know, what's methane emissions and why do they matter? And then it was, well, does a certain company have a methane target? And now the conversation's at like a 3.0 level. Does the target include non-operated joint ventures? Is the company implementing that methane target and demonstrating progress credibly with empirical field data of methane measurement that may have some independent verification? So the acumen of the investor community on topics like methane emissions has steadily risen over the last several years. And one of the great things about that particular topic is it is so solvable with technologies and management practices like leak detection and repair, like good site design, like training and incentives to keep the natural gas in the system and out of the atmosphere.
So one thing for you, Ben, you heard our lead in, right? Which is we're watching energy companies and prices and the financial environment every week, and there's a lot of stress in the system. Are you concerned over the next 2-3 years that the financial stress is going to lead to a slowdown in doing a lot of the things that we're going to help the sector get cleaner? Or are you confident that we can, that those things will find a way that we'll protect those things and do them anyway in spite of the stress?
You know, I think time will tell, and it may be complicated. Goldman Sachs was out with a new report they called Carbonomics, I think, last week, in which they projected that actually in 2021, for the first time ever, renewables will be the largest area of investment in the energy sector. And their view actually is that we may see some tailwinds coming out of the crisis, or certainly the disruption that we're in, that lift, if not all boats in the decarbonization journey, at least some of the boats. For something like methane and flaring, and those both really get back to doing oil and gas right, those are cost-effective opportunities. I really don't think that there needs to be a setback at all, notwithstanding the economic downturn. You know, Craig asked about flaring. We recently commissioned Gaffney Klein to reach out to operators like Chevron and Pioneer to learn how they are getting their flaring challenge under control. And the good news is those firms and a couple others have made some really, really good progress. And what was interesting to me about the Gaffney-Klein report, this is publicly available at our website, EDF, and the Baker Institute and Gaffney-Klein, is that solving the flaring challenge, it's not a technology problem. It's a leadership problem. And the firms who are solving it are doing it with good old-fashioned blocking and tackling at the management level, making flaring reduction a priority, setting a target, linking performance to compensation, improving that infrastructure planning so the takeaway capacity is there when the well goes online. And the truth of the matter from this paper is that the magic technology for solving the flaring challenge has been under our nose all along, and it's not some whiz-bang Internet of Things or some chemical reaction that you've never heard of. It's a pipeline. And the companies that have done a good job at getting to 1% or less in terms of their flaring intensity, they're planning and coordinating with their midstream partners, because the best flare is the one you never even have to put up in the first place.
Ben, ESG, sometimes when you're around it, it feels so good because investors are asking good questions, asking for better incentives, better governance, better culture, better practices in the field. It's all good. And sometimes you're around it and you say, wow, what a dizzying array of numbers, none of which make sense. Ratings don't seem to correlate to anything that really matters. Are you, it sounds like you're an ESG optimist in terms of how it's going to ultimately help us. But do you think it's going to improve and get, I don't know exactly what the right word is, but get a little more substance and a little less, I don't know. Because as you know, two companies can have completely different ESG ratings based on however many services are out there.
I think you're absolutely right. And I am an ESG optimist, but we've got work to do as a community of practitioners that have an interest in seeing that space evolve right. Look, the reason that I'm optimistic about ESG is that the demand is large and growing. And the business case fundamentally is strong because study after study has shown that strong ESG investments at least meet, but quite often beat, the financial performance of non-ESG investments. So the fundamentals, if you will, to be bullish about the growth of ESG, I think are there. But again, there's work to do. I would almost say that ESG is kind of like an early adolescent. It's kind of in that phase, starting to grow up, a little messy, a little bit in fits and starts. And there's some work to do on standardization, absolutely. One of the things that we try to do at Environmental Defense Fund is to help investors understand at least our point of view, a point of view on what does good look like for environmental performance in certain areas, and what are the measures, the KPIs, if you will, the data sources that you should be acquiring and assessing to determine who is leading and who is lagging, and to support you in having the most data-driven and constructive dialogues that you can with management teams. We're doing that on methane emissions. We're doing that on flaring, and we're going to be doing more and more work with the investor community, certainly in the months ahead, because the demand is there, the appetite is there, and we know that when investors pick up the phone, management teams answer.
Just picking up on your comments, I think that's spot on with what we've heard from the industry in the downturn. As things have slowed down here, operators ended up shutting in wells that were flaring, made sure that they got infrastructure in place once they bring that shut-in production back on to avoid that flaring issue. And it does look like we're going to be going long infrastructure for quite some time out of a lot of these basins as the industry moves more towards a low-growth business model. Away from gas flaring, what do you think the one or two other topics that investors should be focusing on from an environmental perspective that the industry can help tackle in order to improve our environmental footprint?
So methane emissions is right up there, and flaring and methane are two sides of the same coin because they both get back to environmental stewardship of natural gas. And actually, you can't solve the methane problem without solving the flaring problem, a recent study we did with a helicopter found that in the Permian, more than 1 in 10 flares was unlit, which can mean venting of methane raw into the atmosphere. So look, a number of companies have made good commitments around methane emission targets, such as targeting a methane intensity of 0.25%. What needs to happen now, and this gets back to the earlier conversation with Maynard about the growth of ESG, is companies using high quality data to demonstrate their progress. Because the status quo historically has been literally using a desktop calculation. It's kind of like going like this to estimate your methane emissions. When we know from scientific study that the only way to get a credible answer that investors can actually believe in is to use a drone with a sensor, an aerial overflight with sensors and so forth to take some real methane emission measurements. And I think investors are getting increasingly savvy about that to really test companies who are telling a good story. Can you back that up with real measured data to show progress that we can believe in, just the way we would, of course, insist on for a core financial metric? So flaring and methane are a couple of key ones. And then more broadly on energy transition, look, we get that every management team is a little bit different. There are going to be different philosophies and different approaches when it comes to diversifying your business model, maybe entering into new ways of meeting society's energy needs. But I think given that the growth in this industry is really projected to come outside of traditional forms of supplying fossil fuel energy, management teams at least owe it to themselves and to their shareholders to take a hard look at whether there are at least some opportunities where they can leverage competencies that they have, or maybe competencies that they develop to bring a more balanced energy portfolio to the marketplace. And also to access lower cost of capital financing. The recent Goldman Sachs report, Carbonomics, talked about how investors are effectively providing much, much lower cost of capital resources for renewables in certain areas of cleaner energy development as opposed to hydrocarbons. Do we see hydrocarbons going away tomorrow or being eliminated in 10 years? I certainly don't. But I think a prudent management team is going to be thoughtful and go from drill, baby, drill to think, baby, think, including thinking a little bit differently about their business model.
So then one way to minimize or eliminate flaring and venting problems, especially on the margin, is to increase nuclear. And I heard you that EDF doesn't get too forceful on promoting one technology over another, but we do see a lot of people among your ESG peers who really don't like nuclear. We all understand why. How do you guys think about the fact that the U.S. is at a 20% share in the electric generation stack coming from nuclear, the technology, that's basically half a century old, if not older, and yet we now have, nuclear 2.0, nuclear 3.0. What's your sense of whether that 20% number should go higher, will go higher? Does it go lower? What's your opinion on it?
I don't have a strong sense. I'll have to defer to some of my colleagues who've studied the nuclear issue more closely than I have. My own 2 cents, if it's zero carbon or low carbon, as nuclear obviously is, then it deserves a fair shake. And again, let's get that technology neutral competition to deliver clean energy at low costs. I guess the big question that I have around nuclear is it cost competitive? In a world where we've seen over the last 10 years, the cost of renewables absolutely plummet. The percentage of renewables for new installed capacity growing dramatically. And of course, you do have cheap gas. Now, that's not without the methane challenge and the CO2 challenge that absolutely need to be addressed. But I think I would want to understand better what exactly is the case for nuclear in the marketplace. And if there is one, can we make sure that it's done with the environmental safeguards so that none of us has to confront or lose sleep over a nightmare scenario that we can't afford?
Well, just as a follow-up for that, we often see that the solar and wind costs are levelized costs of productions that do not include a social cost of carbon. And so, going back to what I said with the emissions market at the start, if nuclear is zero on the emissions side and probably does have some secondary, pickup of CO2 emissions through materials. So if you get to, a broader definition of the footprint, you probably pick up some, you probably would have to do that calculation just to make sure that nuclear probably is a lot cheaper than even wind or solar, just given the amount of hydrocarbons that go into it.
Yeah, no, that's fair. I may have misunderstood. I was somehow interpreting your question as building new nukes, but what I'm hearing you ask about is when you've already sunk the fixed costs, you've done the CapEx, and you've got an aging fleet where there's a sort of limited ongoing cost, you go ahead and make the investments to keep it safely running in business and providing zero carbon electricity. I think that's a great question.
Ben, you mentioned data, and transparency of data is obviously a big deal. And maybe you can just touch on a couple of the other things that are sort of interesting going on at EDF as far as monitoring, methane monitoring, and satellite monitoring. When we take a look at the NOAA data versus the Texas state data, it tends to show much higher emissions, and so maybe you can just touch on some of that stuff.
The one takeaway that's clear is that virtually every time independent scientists, groups like ours, others, have gone out to take real methane emission measurements, they've been higher than self-reported estimates based on so-called emission factors and engineering calculations, which are really just educated guesses that, again, are those desktop-based Microsoft Excel models. And we want to get a paradigm shift where measurement and monitoring really is the new normal. That's why through our subsidiary, we'll be launching a satellite that we not so creatively called MethaneSat. In late 2022, early 2023, we're working with Harvard and Ball Aerospace and the Smithsonian Atmospheric Observatory and others. And the idea behind MethaneSat is to create public, high-quality, free global data that captures the methane emission quantification from almost all of the world's oil and gas producing and consuming regions. We think it's going to be a really powerful tool. I can tell you that the investor interest in this project really has been through the roof, and our colleagues in the operator community certainly have a lot of questions and a lot of interest as well. So we think that's going to be a good contribution. We want it to be constructive. We want it to be used in a way that helps reduce emissions by companies, by policymakers and regulators, and of course by investors in their dialogues and in their engagements. And then a little closer to the land and a little nearer in time, again, we got to finish the job on flaring. And we were pleased that JP Morgan Asset Management publicly recognized that places like Texas can eliminate routine flaring by 2025, and that voluntary efforts, valuable as they are not sufficient. That we need governments to put in place policies, regulations, and enforcement to achieve that zero routine flaring by 2025. And we're hoping that more of our colleagues in the investor community will join that call from EDF, from JP Morgan Asset Management, from others. I know Bobby Tudor has talked really eloquently about the need to address these challenges and the role of policymakers in tightening the screws. There was recently a recommendation, I think, to the Railroad Commission from some folks in industry, and there were one or two things in there that we certainly think we can work with, like gathering and disclosing better data on flaring. Who could be against that? But the truth is their recommendations fell far short of where they need to be with targets, timelines, and requirements to put this eyesore of the oil field behind us and get an ESG win that we can all feel good about.
Boy, Ben, I was having such a good time until you mentioned getting the government more involved in our lives. It's been a long 3 or 4 months in that department. I'm just teasing you. One couple of quick questions as we wrap up. You guys have done such a great job staking out what I think Scott Tinker calls, the rational middle, trying to be a science-based, quantitative-based, economic-based organization. How do you continue to hold that ground? And what is it about the culture? If I had the ESG rating of EDF, what would it tell me about the culture of the organization and how it's able to hold that ground and stick to that purpose and be of service in this way?
There are a couple of things that I think make us who we are as EDF. One is our independence. So for us, it's very important that we don't take a dime or a dollar from any of the companies that we work with, from any of the investors that we work with. So it's not a service relationship. It's not a client relationship. We work together respectfully and constructively as co-equals with companies, with investors, and with others. And with that independence, it means that we can call it how we see it. And I believe in that so strongly. When a company does something good, they ought to be recognized. They ought to get an attaboy, even if it's a company that's doing some things that are not so good in another area, even if there are areas in which we agree to disagree, and we can give credit where credit is due. One recent example is working with Chevron on this Gaffney Klein paper. We've had some areas where we've really disagreed with that company, but we noticed that they were doing a very good job of reducing their flaring year over year through a dedicated program. And so we were pleased to work together on showcasing that and creating a fact base from them and other companies so that policymakers and industry can learn from that. The other thing is we are critical where we feel that there's a need to be critical. We're not afraid of calling it how we see it, including pointing out where folks are perhaps falling down in their public policy advocacy, in their target setting, in their business models or other areas. And so that's really what we want to be. We want to be a straight shooter. I think you create trust that way. I think people work with you when they know that you're going to call it how you see it.
So last thing, because we always like to end on a upbeat, a positive note. And Craig Webster, we owe you a big thanks for getting Ben to come on the show. When you think about the next 10 years, and I know you said you were technology agnostic, you think about the next 10 years, I think one thing that we're getting really excited about is it seems like this debate, broadly speaking, around energy, the environment, economics, and just advancing a human life, it's getting more intellectually honest. People are having to put their cards on the table. We're starting to compare all energy sources. We're thinking about things that we're not doing yet, meaning technology is going to play a role. But as you think about the next 10 years, are you feeling optimistic that the debate's getting better, that the technology is going to improve? What's the momentum in your world? Good, bad, or sideways?
I guess we all have our good days and our bad days. And I know a lot of us are looking keenly at horse race numbers and putting down our wagers on how the election is going to go. But in all seriousness, the biggest thing that does give me optimism really is the rise of investor attention, urgency, and determination to be part of the solution on climate change, to be part of the solution on the energy transition. I think BlackRock sent a powerful signal in the last 6 months or so on this topic, and has reaffirmed that through the challenges and disruptions that we've had in the last few months. And what I think we're likely to see is the largest asset managers in the world, not overnight, but in the years to come, really figure out how to operationalize the climate part of ESG in terms of where capital goes and where capital doesn't go, in terms of the public policies that they support and engage with companies and their management teams on, and the kinds of questions that they're asking those management teams and the ways that they're voting their shareholder resolutions. And that is a trend that makes me optimistic, in part because it has complete political durability. There is no election outcome you can fathom in the White House, Senate, and Congress that takes the rise of investor concern on climate change and engagement on ESG off the table. And I think that's something that gives me real optimism.
Well, I wish we could go on and on. Ben, thank you so much for joining. We really appreciate it. To our regular team, thank you guys. Great job. And to all of you, stay safe. And we appreciate you as well. Bye, guys.